it's the first edition of the Markets-Based program this year. Thank you for joining us on Capital Market. I'm Temple Ashaju. Most markets globally ended 2018 battered, but the just concluded week saw a few markets ending in green, from stocks to commodities, inclusive of Brent, which is the oil price and the benchmark for us here in Nigeria. In the domestic space, it was a slow start to the year as investors booked profit across major counters, the results to safe havens in the run-up to the 2019 general elections scheduled for February 2019, which is just next month, a few weeks away. With analyst consensus on a dampened 2019 economic outlook, we can't stop getting them more for your investment decision and, of course, your portfolio rebalancing, as financial markets are expected to remain downbeat in the first half of 2019. On that note, we'll be engaging an analyst on the program this evening to give us a sense of what to expect, when to expect it, and, of course, what to do as corporate or retail investors this year, 2019. But before we engage him, let's begin with some market news that will help you to take your decision for next week. We'll start with a story coming in from the Nigerian Stock Exchange, placing the shares of Continental Reinsurance of full suspension following the proposed scheme of arrangement for the acquisition of all outstanding and issued shares of CRE, a subsidiary of the company, for cash or share settlement. Now, the exchange explains that the step is necessary to determine shareholders that will qualify for the receipt of the scheme consideration in line with resolutions passed at the court-ordered extraordinary general meeting held on December the 20th, 2018. Continental Reinsurance during the week also explained that it has no plans to delist from the Nigerian Stock Exchange, but to restructure its business model in favor of CRE, its subsidiary. And the Nigerian Stock Exchange has also accepted the supplementary listing of 11.886 billion ordinary shares of 50 kobo each, belonging to Cement Company of Northern Nigeria. Now, the addition represents the scheme of merger between CCNN and Kalambena Cement Company, a subsidiary of Boa Group. With the listings, CCNN's total issued and fully paid up shares of this company now stands at 13.1143 billion from 1.256 billion ordinary shares of 50 kobo each. Still with the stock exchange and the equities, the exchange has lifted a trading suspension imposed on Resort Savings and Loans PLC following the submission of its 2017 full-year result and the cumulative quarterly earnings for 2018. The mortgage firm was one of the 17 stocks suspended on July the 5th, 2017 for non-compliance with the rules for filing of accounts and treatment of default filings. The suspension was lifted on Thursday, January the 3rd, 2019. And now let's move into the way the markets ended this week. Of course, we'll start with equities, where the rout on Nigerian stocks markets continued this week. Of course, the first week of trading activities this year as investors reduced and exited positions on stocks ahead of the elections. As a result of, we saw that most counters on the local bourse remaining undervalued, trading near one-year lows. We saw persistent sell pressures on market bellwethers such as Access Bank, which dipped this week 14.7%, Stanbic IBTC shedding 12.7%, and of course Nigerian breweries in the conglomerate sectors dipping just 3%. All of these drove down the all-share index to some 1.3% if you want to approximate. All-share index at 30,638.90 with equity capitalization at 11.4 trillion naira. Specifically, the exchange reported that appreciated some 0.78%. But volume this week was 1.64 billion, valued at 8.413 billion naira. If you compare to what we had last week, that's a sort of a decline. In terms of the sectors, we saw depreciation across board, except for the oil and gas, which rose 2.91%. Let's move to the NASD representing unlisted securities there, which surged 2.20%. We saw a lot of investors rebalancing portfolio, adjusting and moving away from straight equities in the market, in the Nigerian Stock Exchange, to the unlisted securities market, buying some of the very, very local names there. USI, which represents the index there, settled 749.47, with the market capitalization now hovering around 520 billion naira. We saw volume at 551,890, a decline compared to what we had last week, but volume was about 128 million naira. All that took place in just 11 deals, with major trades seen across 4 of the tradable companies out of the 32 tradable on that particular platform. And in terms of the fixed income markets, we got average ask yield on treasury bonds increasing this week, advancing some 20 basis points to settle at 15.4%. There were increases in yields recorded across most of the bonds, except for 5 key instruments, one of which is the 23rd of March 2025 that you have right there on the screen, that expanded in yields this week. I think that's happened around 4 basis points, basically. You also have the January 2026 expanding this week. Yesterday, specifically, we saw the expansion on January 2026. Basically, we had just 49 deals on bonds yesterday, valued at 15.87 billion naira. And in terms of the treasury bills, we've got the liquidity levels this week bolstered by 690 billion naira inflow from open market operations, repayments out of some 424.5 billion naira. And of course, we saw that playing out this week generally in that space. But if you look at the what transpired yesterday in the market, we represent a bit of what happened this week. Specifically, buying activities in the secondary markets drove average yields up some 2 basis points, and that of course closed at 14.07% for the February 2019 security, which represents a part of the short end of the curve. We saw that discounted of 15%. Generally, we had 358 deals yesterday, Friday, at the treasury bills market, the secondary side of things. They're valued at 101 billion naira. Now, we've been seeing several predictions made about 2019. Analyst consensus is that of economic slowdown in the run-up to the 2019 elections, as stocks are expected to remain depressed, and of course, debt market players react to continued open market auctions from the regulators, whether the central bank or the DMO, because a few weeks we saw the return of the Debt Management Office to the market recently after some 5 weeks of silence in that space. Let's hear another perspective now from Cordros Capital. Bola Hoaino, one of our regulars on the show, and the head of investment from Cordros Capital, joins us now to share his projections with us.
Good evening. Temple. Happy New Year.
I should be the first to say that, actually. Happy New Year.
Thanks a lot.
Welcome. Thank you so much for making it through to the program this evening. Before we actually get your projections, let's begin with what you saw last year, briefly. What were the positives, what were the negatives for you?
Okay. Well, good question. 2018 was a year that we thought was going to be very promising. Can remember the market did 42% in 2017, that's the equity market, and in January it started on a bullish run, gained about 8%. So everybody was quite positive, that this was going to be a good year in terms of market. Also, if you recall, we expected to see MTN listing this year as well. So everybody was excited, everybody was basking in the euphoria that a lot was going to happen in the equity space. But of course, the market declined 17% in 2018, lost 9 months out of 12 months. Pretty much a lot of factors contributed to it, and one was the FPI. We saw that there was a lot of outflow from the foreign portfolio investors. Yeah. And it wasn't just the political scene, it was also more of the trade war between US and China, also because US also increased interest rates. So they hiked their rates by 25 basis points 4 times last year. And of course, investors always look for safety. So they rather move to a climate where there's safety than to an emerging market or frontier market where there was a lot of risk factor. So in terms of negative for the equity market, for the market at large last year, one was the fact that the equity market depressed 17%. Also, the fact that GDP, yes, we've seen a rise in GDP, but growth is still very, very mild and modest. And of course, it's still lagging behind population growth, which is not good for the country. A lot of positive as well last year in terms of inflation. So if you recall, December inflation was at 15.3. As at November figures, it was 11.3. So inflation came down significantly. One was on the back of base effect. Also in terms of positive as well, oil price as well. Oil price went as high as $85 per barrel. And that's like the highest we've seen in about 4 years time or so. Although it's still trending down now, but because it went up, we were able to record significant revenue gains from oil receipts. Also in terms of positive as well, in terms of the yield environment. So yield environment in 2017 was very attractive, was as high as 21% beginning of 2017, because it closed the year around 18, 16%.
But that will be very relative because that will be for investors.
Yeah, so for investors, they're happy. For manufacturers, it's more expensive for them to borrow. So it's like a 2S one. While investors are smiling, manufacturers were not too happy. But a lot of investors were complaining because the yield came down very low this year. But of course, it started to pick up. If you look at the OMO auctions and also the primary market auction last week. So it's picking up. So investors are happy with that. They're basking in the euphoria of that. But the political terrain, as we approach the election, a lot of people are still very scared. So external reserve was quite attractive last year as well, on the back of the fact that oil prices was good. So you saw the CBN defending the naira and ensuring that it doesn't go down further. But a lot of fears that 2019, that exchange rate risk factor is strong. And we are projecting, or a lot of analysts with ourselves as well, that exchange rate could rise as much as maybe about 380 to 390. And so we've seen in recent times a lot of our clients, investors are doing foreign investment just to hedge against the foreign currency risk. Apart from the market as well, in 2018, of course, the resignation of the Minister of Finance. So there's so many news that made the market last year.
It was like the first in a long, long while.
Yes. So. But as we approach 2019, I'm quite optimistic. In terms of election, so it's two scenarios. So, of course, I'm not pitching for APC or PDP. But if APC should win, I think it's more going to be like a status quo. Okay. So there might not be anything significant going to happen in terms of the market space. If PDP win, investors might want to bask in euphoria. That's maybe it's pro-market, depending on how they perceive article and the person in question. So APC, I think, might be status quo. But if PDP win, I think the market might react positively. So if you look at 2011 and 2015, 2011, Q1, the market came down, the equity market, election year. 2015 came down as well, Q1 election year. But after the election, the market rallied Q2. So it's possible that might stay on that rally Q2 2019 post-election.
Okay, so before we go on break, what will be your key events for 2019 that you have seen? I mean, we know there are external factors, there are also internal factors. You just mentioned a bit of the internal factors now. Externally, what are you expecting? So
there's still the global trade fears. So for US and China, they had a truce, a ceasefire for some number of days, but there's still that risk factor that is still there. And US also plans to increase interest rate 3 times 2019. But of course, that means that portfolio flows might leave emerging and frontier markets to developed markets. Also, the ECB as well, they plan to increase rates as well. So all that is going to affect portfolio flows in emerging markets and frontier markets. On the internal side, there are a lot of issues around, is there going to be a hike with regards to the PMS price and all that? If there's going to be a hike as well, that's going to be a major issue, because investors are going to dealing with high inflation, because there's debate about minimum wage and all that. If that comes to play, that's going to cause an increase in inflation as well. So investors, you need to find out to hedge against inflation in your portfolio.
So there's a whole lot of things that will be playing out in 2019, basically, is what you're saying. You talked about the fact that it's a tale of two halves. You've got the first half, and of course, you've got the second half. A lot of people are talking about the fact that there could be some recovery, which you've also alluded to. But what kind of recovery? But for the first half, of course, we also need to have some mitigants to be able to hedge against some of these risks and all of that. In the second half of the program, we'll continue that discussion with Bolanho, and we'll be able to get some recommendations from him as to how you could manage your portfolio. Stay with us.